The Fed told us yesterday we're going to hike 2 more times. The inflation fight is not over. We had the terminal rate expectation move up by 50 basis points with an inflation expectation that only moved up 30 basis points, which sends the message that it's not tight enough yet. We haven't tightened it enough yet. We need to make things more restrictive. The market, in theory, should not like that. But what their action said was, we're going to pause. Frankly, I'm not sold that they're going to hike again. I don't know that they're going to be able to. I do think that there's going to be some kind of reckoning with the liquidity issues that are about to hit the market in a lot of different ways. I don't know that they're going to have the clearance to do it again. The interesting part is that the market just keeps to push it out, right? It says, all right, we believe you might do it one more time. We thought maybe July. Now we think September. So it's possible that we just keep pushing that out into the future and it never happens.
All right.
I think the big issue here is that the market and the Fed still disagree. And at some point, one of them or both of them is going to be wrong. And I think that's going to be a painful thing.
Federal Reserve officials paused following 15 months of interest rate hikes, but signaled they would likely resume tightening at some point to cool inflation. Aim of pause is to allow FOMC to assess more incoming data. Policymakers lifted median rate forecast to 5.6% in 2023. The decision left the benchmark federal funds rate in a target range of 5% to 5.25%. Fresh quarterly Fed forecasts showed borrowing costs rising to 5.6% by year-end.
Let's get to Steve Leisman with the Fed decision. Steve?
The Federal Reserve pausing but raising the median forecast of the funds rate to 5.6%, indicating a very hawkish committee outlook and strong support for at least 2 more rate hikes this year. I think this comes under the definition of a hawkish pause, maybe a very hawkish pause. FOMC statement saying it's holding the target rate steady, allowing it to assess additional information, including the cumulative effects of tightening and lags of monetary policy. The committee sees more inflation this year than it previously did, forecasting a 3.9% core rate versus 3.6 in the prior economic projections in March, and less unemployment, 4.1 versus 4.5. And moving on, they did see better economic growth this year, not tremendous, but 1% versus 0.4%. The statement said the economy continues to expand at a modest pace. Job gains have been robust. Unemployment has been low and inflation elevated. They continue to say tighter credit conditions are seen weighing on the economy, hiring, and inflation, but they don't act as if they will. Decision was unanimous, guys. I just say, in terms of a hawkish pause, this is for sure that, with at least 2 more rate hikes forecast by the majority of the committee, and some want 3 and some want 4.
Chair Jerome Powell said nearly all Fed officials expect it will be appropriate to raise interest rates somewhat further in 2023 to bring down inflation. He declined to say whether another hike could come as soon as July, but emphasized that it would be a live meeting.
I don't believe the Fed's going to raise rates again. I think Jay Powell has a really difficult job right now because, as Steve is correctly pointing out, I think he realizes that we're at a turning point potentially on the inflation situation and on the economy, and yet there are people that are dedicated to these lagging indicators like employment, labor market, and certainly looking at core CPI. Well, it lags. It just does.
I mean, the point here is that they're done. They're not going to hike. Doesn't matter what they say. I mean, that's what the market is saying today.
Right.
It has to be.
So what do you think? Do you think that the Fed is bluffing and just buying time? Do leave your thoughts and comments below. Smash the like, share and subscribe button if you like to see more content like this. And welcome back once again to our DS Happy Living Lifestyle Investors channel. Let's continue.
Right?
Yeah, I saw that interview live with Jeffrey, and I actually agree with pretty much everything he said. I think, the bull case right now is that inflation has come down in a pretty linear fashion, and you could sit there and say, you know what, it's less than half of what it was at its peak last June, and that's a good thing, right? Pricing pressure is down. That's a good thing for consumers. You could also sit here and say, yes, but it's still twice what the target is, which means that the job is not done. And you have to then ask yourself, even if they're done hiking, if you believe that we're in this higher for longer regime, if we sit above 5% Fed funds rate for a really long time, Number one, can capital sustain that? Can businesses get capital in that environment? We're already hearing that small and mid-sized businesses cannot as much as they used to be able to. You've got liquidity pulled out, and if you just chart liquidity over what typically happens in the stock market, particularly in tech stocks, you see it follow the way down. And there's a huge divergence right now. You've got tech stocks rallying, you've got the market rallying, liquidity expected to fall pretty precipitously over the coming months. So one of those two lines has to meet, right? And the liquidity one is probably not going to come up.
You think we're going to have a recession? What's your base case call on that?
If I had to answer that in one word, yes.
It's a little bit more kind of, hey, we got this inflation under control, but that's not what he said. He basically did a little self-deprecating, to be honest with you. He said, look, we're not really good at forecasting inflation. We messed it up before, and that's why we're a little worried. And that's why we think we've got to have some insurance out there that we go again. And I think that kept a little cap on the market.
Yeah.
Even though the pause is nice.
Yeah. And I think that it came up quite a bit, actually, in the press conference, this idea of why pause if so hawkish and so concerned about the stickiness of inflation?
Yeah, I think that's right. I think the folks that were questioning him were like, well, look, you've done a good job. Why not kind of declare victory? And I think he's scared of what's happened in the last year or year and a half with inflation, and rightfully so. We've had a spike to 9.1%. We're down all the way 510 basis points to 4% in CPI now. It's good news. But, Morgan, I think one of the more interesting nuances of all of this was Jay talking more about how difficult it might be to get inflation, core inflation, down to where they want it to by the end of the year. And I think that keeps these rate hikes a lot more alive than people think. I mean, we've got to go from 4.5 core PCE to 3.9, and we've been trending the other way for a couple months. So, and upgraded the strength of the economy, right? So the markets, it's kind of hard to say you want to sort of call this the perma pause. I think that's a really hard one to get.
Inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. Jerome Powell said at a post-meeting press conference, "We've covered a lot of ground and the full effects of our tightening have yet to be felt," the Fed chief said. He suggested rate cuts are probably a couple of years out, once inflation comes down significantly.
If you look 2 and 3 years out with the forecast, first of all, I wouldn't put too much weight on forecasts even 1 year out because they're so highly uncertain. But what they're showing is that as inflation comes down in the forecast, if you don't lower interest rates, then real rates are actually going up, right? So just to maintain a real rate, the nominal rate at that point 2 years out, let's say, should come down just to maintain real rates. And actually, since we're probably going to we're having real rates that are going to have to be meaningfully positive and significantly so for us to get inflation down. That probably means that certainly means that it will be appropriate to cut rates at such time as inflation is coming down really significantly. And again, we're talking about a couple years out. I think, as anyone can see, not a single person on the committee wrote down a rate cut this year, nor do I think it is at all likely to be appropriate if you think about it. Inflation has not really moved down. It is not so far reacted much to our existing rate hikes, and so we're going to have to keep at it.
Thanks for watching. Like, share, and subscribe.